VA assumable loans, does it always make sense? Well, sometimes it doesn't. And we're gonna show you exactly how we crunch the numbers for our clients to see what the actual value of that property is and what the right price to offer is. So stick around to get all the details. See you on the other side. All right guys, so like I mentioned, we have been doing a ton of VA assumable loans. With the way the rates are right now, it's pretty sexy to see yourself in a situation where you could assume somebody's loan with a 2.5 or 3% interest rate. And we do find them a lot out here. Now, if you want to get your hands on one of these lists, feel free to reach out to us. We've got a link down below where you can book a call with us, where we can get a better understanding of your situation, what you're looking for, and see if we can build a custom list just for you to show you what active properties are out there that could allow you to assume a 2.5 to a 3% interest rate. So book that call down below, or feel free to reach out to me at my number right here. With that being said, one thing that we discuss with a lot of our clients is what is the value of a VA assumable loan? Because a lot of times we find that these properties are being sold somewhat at a premium because you're taking over a loan of 2.5, 3%, which could save you hundreds of thousands of dollars every single month. So it could be kind of difficult to understand, well, what is the true value of that property if I'm actually gonna be putting money towards the cash gap to save money? What's the break-even point? Well, I'm gonna show you in a second here how we actually calculate that for our clients to make it a very straightforward process to see if you're overpaying for a property or if you're getting a smoking deal. With that being said, let's go over a little bit of housekeeping of things you need to understand about VA assumables. The first thing you need to understand about VA assumables, they do take a lot longer. I got a video and a playlist right here that goes over the pros and cons and everything you need to know about VA assumables, so make sure you check out those videos right there. But they do take generally some words of 3 to 4 months, sometimes longer than that, but we have a process that usually speeds up that process. But with that being said, we do have a team that specializes on the paperwork when it comes to VA assumables that generally keeps the process pretty smooth and quick. Another thing to keep in mind is generally there's going to be a cash gap. Usually there's gonna be a cash gap anywhere between, I'd say the lowest is about 30,000 and upwards of 300, 500,000. But we find that a lot of homes right now in that $600,000 to $900,000 price point are seeing cash gaps between about 50 to 200 grand, somewhere in there. So you're gonna have to have access to those funds. And now with the second loan, that's very difficult to do. There are sometimes some solutions for that, so feel free to reach out to us so we can explore that. But generally you're gonna need access to that cash, whether you're pulling it from your TSP, from some savings that you have, and sometimes it doesn't always make sense, but we always help our clients with figuring out whether it does or whether it doesn't. And the third thing you need to really keep in mind, which we're gonna go over today, is what is the value of that property, because with VA assumables, there is no appraisal. So you don't have the backing of an appraiser showing up and actually telling you, okay, that property is actually worth X amount of dollars. You need to have either an agent do an analysis for you, or you come up with a number that you find is fair for that property. How much is the value of that 2.5% interest rate? Well, we have actually created a software, an application that allows us to not only figure out what fair market value is, but also what is the premium of getting that 2.5% interest rate, putting those together to help us understand what the range is and the value of that property based on that 2.5% interest rate. So let's jump on my computer and show you just a sample of how we do this for our clients. Okay guys, now I want to jump on my computer as me and Tristan over here at Team Roger that are very data heavy as well as tech savvy when it comes to utilizing tools to assist our clients. And this is one tool that we've created, an application that allows us to analyze VA assumables. Now, it's not as straightforward as just doing a CMA or a comparative market analysis, where you just look at the similar properties that have sold in the area in the last 180 to 365 days, similar bedroom, bathroom, square footage, and quality of renovations. But the other thing that you need to factor in is what is the value of this property, since you're going to be getting an attractive interest rate. How much is it really still worth if you're getting a 2.5% interest rate compared to, let's say, a 6.75 or 6% interest rate? What is the value of that property? Why is this so important? Because you're going to be coming out of pocket to cover that cash gap, whether it's $100,000, $200,000, $300,000, where you could put that in an index fund and get, 4 to 7% return on that, or you could put it towards a real estate deal where you can get an attractive interest rate. Now, there's a lot of different things to factor in. It can get very complicated, but this application allows us to punch in a couple important aspects of the deal and help us come up not only with the price point, but also see what the savings are and really factor in, questions we like to ask our clients. How long are you going to hold on to the property for? Because that allows us to create a benchmark of what the most that you should pay for this property and create a ceiling. Because one thing that's important to understand about VA assumables is it's very mysterious on what the value of that low interest rate is, but we kind of debunk what that mystery is because we can actually see the crunching of the savings, but also how long it takes to hit that break-even point for all those savings. Does it take 2 years, 3 years, 5 years, 10 years? And then additionally helping us understand what is the price point that we should offer that still makes it a deal, because with a VA assumable, there is going to be no appraisal. And the appraiser is generally somebody who's kind of your backboard to make sure that you're not overpaying for the property. Now, if you have a good agent, they're going to do a pre-appraisal, which is what we do for all of our clients. But doing an appraisal on a property with a low interest rate adds this mystery number of value that a lot of people don't know how to calculate, but we do it for our clients. We're going to show you exactly how we do that more or less with this application. And we'd be happy to do this for you. So this is just a subject property. We took out the actual address so that we're not leaving anybody out in the cold here. But just to kind of show you what these snapshot application reports show us, is it allows us to do first a CMA on the property based on other properties that have sold in the last 6 months to 12 months, similar bedroom, bathroom, square footage, and quality of renovations. We start making adjustments for the square footage, the condition, whether it has PV, and whether that PV system has a certain amount of panels, whether it's owned, whether it's leased, and a few other adjustments. And of course, for the HOA adjustments as well. There's a lot of things that go into this. And then it gives us a fair market value for that property without the assumption. The next step that we want to look at is what is the savings with this property if you were to purchase it with that VA loan. And in this situation, it's 2.5. We can see just using a benchmark of 6.75, which is probably a little bit more on the high side. We're seeing closer to 6.25 for VA. This would be a savings of about $1,460 a month. That's $87,600 over 5 years, which is this client told us they'd be holding it for a minimum of 5 years. So it kind of shows us what the value of that savings is. And then we need to kind of get a better understanding of, okay, if we're putting in X amount of dollars for the cash gap, at what point does this still make sense for the savings? And that's where this starts to make it a lot easier for us to put in an offer on a property, even if it's over asking for that assumable. Or what a lot of people tend to do, listing agents, is they list their property higher because they're not sure what the actual value of that assumable is, and they just kind of throw it out there and see if someone's willing to pay it. But we don't like to make any guesses. We use data to drive our decisions, and we can see in this scenario, these guys were listed a bit higher. They were listed at 875, but we saw that the valuation of where the savings really was for the cash gap of 138 grand was about $853,000. Right? Anything above that, you're starting to pay a premium, and those savings for the money that you're putting into the deal to get that assumable rate, if you're only going to hold on to it for 5 years, starts to push out the amount of time that you need to hold on to that to get that break-even point, right? So this is, again, just a quick breakdown of what we do for our clients when it comes to analyzing deals. This is a very much more in-depth one because it has to deal with assumables, but you want to make sure you're working with an agent that understands VA assumables, understands valuations, understands the process of making sure you're still getting a deal and not getting swooned by an attractive 2.5% interest rate. Because if it's going to cost you a lot to get that rate, what is the true savings? What are the pros and cons? And that's what we assist our clients with. So again, if you want to get your hands on something like this, feel free to reach out to us. We've got a link down below where we can kind of discuss your wants and needs, discuss what's out there in the market, and then of course analyze the deal if it presents itself. So that's it for now. So as you saw, there is a different value for a property. When you look at a property, there's really only two valuations. You've got appraisal value. What is it worth based on what is sold in the last 6 months, similar bedroom, bathroom, square footage, and quality of renovations. And there's market value, what's someone willing to pay for it. But there's almost one there right in the middle, which is probably more on the market value side of things, is what is someone willing to pay for this, given that they're gonna get a 2.5% interest rate. And because you're getting no appraisal, you need to have somebody backing you, showing some data to actually show you what the savings is, what the break-even point is, all these different aspects, because you don't want to find yourself assuming a loan and way overpaying for it. And as you sell it in the future, that gap gets larger. And so that aspect of reselling it with the assumable aspect is probably not going to be an option for you. So it's really important that you set yourself up for success. And a lot of times when I tell my clients, if we're going to do VA assumable, make sure you hold on to it for a long time, because there's going to be a break-even point of how much you're actually paying to get that rate. And you don't want to overpay for the property, get a really sexy rate, and then sell it 3 years later when you PCS out. So again, if you want somebody to help you with VA assumables, help you analyze these deals, we are very much data driven, so we'd be happy to be those guys for you. If you want to book a call with us, there's a link down below where you can book a call with myself or my partner Tristan, and we'd be happy to guide you through this process, explore this as an option for you, and assist you in any way we can. With that being said, I'm Patrick Longley with Team Roger That. Hope you have a beautiful day, and I'll talk to you soon. Aloha.